Hi, and welcome to Commodity Market Analysis. We're working with technical analysis, and in this part, we're going to look at charts and indicators. So the first thing you do when you get some data is to plot it. And if you have time series data like prices, then you plot it with the time on the x-axis and price on the y-axis. And the time scale is often daily because on a daily basis, you get several prices, like the close price, which is often used, and the high price, the low price, and the open price. And the scale on the y-axis, the price axis, is either linear or logarithmic. If you have a logarithmic scale, then you linearize exponential trends, which means that you can perform, for example, a regression on this data and a linear regression and still fit an exponential trend. And the simplest kind of chart is the line chart. And here we have plotted the closing price. And for increasing prices, the line segment is black. And for decreasing prices, the line segment is red. And this line chart is often combined with a bar chart, which indicates the volume traded per day. Another kind of chart would be the bar chart. And here you use the information from the open price and the high price, the low price, and the close price. The high price is the highest the price had been intradaily, and the low price is the respective lowest point of the day. And if the price went up, the bar is black, and if the price went down, the bar is red. And the left point of the bar, the tag on the bar, is the open price, and the right tag on the bar would be the close price. And this chart contains more information than the ordinary line chart, which usually only contains the close price. A different version of the bar chart is the candlestick chart, where you can more easily see the color coding for an up move or a down move. A special kind of a chart is the point and figure chart. And as you see here on the x-axis, it's not linear, but you mark the year end, okay, the end and start of the year, and the months are signified with numbers, okay. So and the 3 last months in the year are signified with A, B, and C. Okay, so how do you use this chart? Well, whenever a price breaches through one of these lines, you put either an X for an up move or a circle for a down move. So for example, here we see that the price went up from below 2340, and it went up until it breached 2370 and 2380. Okay, but in April it went down until it is now at 2328.95. So the main benefit of this chart is that it's more easy to get rid of noise in the signal, so that you can clearly or more clearly identify trends in the data. And key to technical analysis is the trend. Remember that this was one of our assumptions, and the idea behind the trend is that what happens to the price process today affects the price process tomorrow. So here we can see that we have a clear trend, but in technical analysis, what we also want to identify is the reversal. This is when a trend breaks and the price process goes the other way. So how do you actually find the trend? And there might not be a trend. So we need a definition. We need a definition of what a trend is. So we can define an uptrend as a series of higher highs and higher lows. In this quite simple graph, you can see that the highs of even numbers are increasingly higher, and the lows of odd numbers are also increasingly higher as time goes by. And if these criteria is not met, you would have a reversal. And the trend might go up, it might go down, and you might even have a horizontal trend. So here we are back at what kind of horizon the investor has for his or her investment. It can be long-term or shorter term, and based on this, the trend lines would be fitted accordingly. So here we have fitted a resistance trend line, which connects the highs. And what happens is that if the price process hits the resistance trend line, it will either bounce back down, or it will go through the trend line, and that would signify that the price would increase more in the future. If you connect the trend line to the lows, then that would be a support trend line. And if the price process hits the trend line from above, it would either bounce back, or a breach of the trend line would signify that the price would drop even further. So what happens when the trend line is breached? Well, then the trend line will reverse its role. So a resistance trend line would become a support trend line, and a support trend line would become a resistance trend line. So what about volume? Well, the volume is the number of contracts traded or stocks traded, and volume is often used in conjunction with the price direction. So if you have a price going in either direction, up or down, but the volume is low, then this is a weak signal, indicating that the trend will not continue. Whereas if you have a price move on a high volume, then that would indicate a strong signal that the trend will continue. As you can see from the chart, the price process is quite jagged. It contains a lot of noise. So to smooth this process, one of the most important and most used techniques is to create a moving average. And there are several moving averages you can make, and the most important decision you face is to see how many legs do you want to include in your moving average. So here we see the blue line. It contains the average of the 50 last prices, and the red line contains the average of the 200 last prices. Okay, so you have a short moving average and a long moving average. And you have different moving averages and weighting schemes, but the most popular weighting scheme is the exponentially weighted average, where the last price, the price yesterday, has a higher weight than the other prices, and the prices, the weight of the prices decays exponentially. Okay, and these moving averages, they are used to tell you something about the price signal. So for example, you can have a moving average crossover. So if the short moving average, the blue line, crosses the long moving average from below, then that would indicate as a buy signal, a bullish signal. If the short moving average, the blue line, crosses the long moving average, the red line, from above, then that would indicate a sell signal. The other tool in the trunk for technical analysis would be the indicators. And these are calculated based on price and volume. And there are two kinds of indicators, which are oscillators. And oscillators, they oscillate, they vary between a minimum and a maximum value. And when the value of the oscillator is such that it is even very high or very low, that it has breached a level, then you either get a signal that the asset is overbought or oversold. You can also get a signal if the indicator moves in one direction and the price moves in a different direction. In addition, you have the non-bounded indicators, and these do not have a minimum or a maximum value. An example of the non-bounded indicator would be the moving average convergence divergence indicator. This measures momentum, and it's just the difference between moving average of a short term and a long term. In addition, you have the relative strength index. It's quite popular. It's also a momentum indicator, and this is a bounded indicator. It's an oscillator. So if the value is below or above a certain threshold, you would get a signal that the asset is either oversold if the value is very low, or the asset is overbought if the value is above a certain threshold. And you have the stochastic oscillator, which works in basically the same way as the relative strength index. So here we have some values, some example values for you to use, but these values, they are not cut in stone. You have to look at each price process. So what's the problem? Well, the problem is that even though you do technical analysis, you often get false positives, which means that you get a signal to make a position. For example, you get a bullish signal, you want to buy the asset, but the asset moves in the opposite direction. And this is actually somewhat difficult to test statistically. And one of the major problems of technical analysis is that investors often look at historical data and they find that, well, what should they have done? And they think that the same will happen in the future, which is difficult to know. But if something works 60% of the time, then you have a probability to make profit. So often you don't need to have a high success rate. Even lower than 60% is sometimes enough. You don't need to have a very high success rate for technical analysis to be profitable.